All right, let's dive into a really unique stock trading strategy. This one is all about generating some extra income, but without all the usual stress of having to be glued to your screen 24/7. So let's get right into it.
You know that feeling, right? That pit in your stomach watching the stock market go up and down like a roller coaster? I mean, the idea of making money from trading sounds great, but man, the reality can be just exhausting. So, what if there was a different way to play the game?
This chart really lays it all out. You've got day trading over here. It's intense, you're always watching, and let's be honest, it often forces you to sell at a loss just to cut your losses. But the strategy we're talking about today, it's built on a completely different idea. Set it and forget it. It's all about believing in a company's real value and just holding on through those temporary dips instead of panic selling.
So what is this magic approach? Well, the source material calls it a hybrid. It's like taking the best parts of two different classic investment ideas and mashing them together. The whole point is to get the best of both worlds, that potential for regular income, but with the safety of a long-term mindset.
In this quote right here, from the one and only Warren Buffett, is pretty much the foundation for this whole thing. It just flips a switch in your brain, right? It forces you to stop worrying about what's going to happen in the next 10 minutes and start thinking about the next 10 years. You're not just gambling on a ticker symbol, you're investing in a solid company you'd be happy to own for a decade. And that belief, that becomes your safety net.
And that Buffett quote leads us perfectly to the first piece of this puzzle, value investing. The idea is actually pretty simple, but it's so powerful. You're basically a bargain hunter. You're on the lookout for great companies that, for whatever reason, the market is kind of overlooking right now. You buy them with this quiet confidence that sooner or later their true value is going to shine through.
Now, to make this strategy super easy to understand, the source material uses this great metaphor. So forget about all the complicated charts and confusing jargon for a minute. Just think of this whole process as a simple bus trip. Here's how it works. Every stock you invest in is like getting on a bus. Now think about it. You wouldn't get on some rickety, unreliable bus for a long trip, would you? Of course not. And the same idea applies here. You only pick buses, companies, that you fundamentally trust to get to their final destination. And this bus journey has 4 simple steps. 1. Choose your buses, those top-quality companies. 2. Buy your ticket. That's your investment. 3. Set your destination, your profit goal. And 4. The best part. Enjoy the ride. You just wait for the stock to do its thing without stressing over every little bump in the road. So let's start with step 1.
All right, this first step is, without a doubt, the most critical one. I mean, the quality of the buses you pick, that determines how safe and smooth your whole journey is going to be. If you get this part right, everything else just kind of falls into place.
So what exactly makes a good bus? Well, you want to focus on established companies, the ones with the proven track record. A good rule of thumb is to look at businesses you actually get, whose products you use. And a really handy metric here is the price-to-earnings ratio, or PE. In simple terms, it just tells you if a stock's price is reasonable compared to how much money the company makes. A PE somewhere between 1 and 35 usually means it's not some overhyped, crazy expensive stock. This is why you stay away from those flashy but unproven startups.
And just to give you a concrete idea, the author shared this list of companies they personally use for this strategy. You can see they're all big, well-known names. Now, of course, this isn't investment advice. You always got to do your own research, but it's a perfect illustration of the kind of reliable, steady buses we're talking about.
Okay, so you've picked your bus. Now it's time for steps 2 and 3, buying your ticket and setting your destination. This is where you lock in your profit target, and, this is key, automate the whole thing. Let's just walk through the Disney example from the source material to see how this works. First, you buy your ticket. The author suggests investing the same amount in each stock, just to keep it simple. Here, they're starting with $6,500. Next, you set your destination. Now, this isn't about getting greedy. It's about setting a realistic, achievable profit goal. For this trip, the target is a nice, clean $500.
So, how do you know when you've arrived? Well, based on your initial investment and how many shares you bought, a quick calculation tells you the exact share price that will get you that $500 profit. In this case, it's $119.84. That number, that is your destination.
And here is the absolute best part. You don't have to sit there staring at your screen waiting for the price to hit that magic number. Nope. You use something called a limit order. You just go into your brokerage app and tell it, hey, when this stock gets to this price, sell it for me, automatically. You literally set it and forget it. The bus automatically stops and lets you off right at your destination.
So, the limit order hits, the trade closes out, and boom, that profit is sitting in your account. The bus trip was a success. But what you do next is actually just as important as the trade itself.
You've basically got two options here. You can pay yourself a little salary from your winnings, creating some real passive income, or you can reinvest that money and let it grow even faster. Either way, the main goal is the same. Get that money back to work. As soon as one trip is over, it's time to hop on the next bus.
Okay, and here's a quick but super important reality check. Taxes. In the US, any profits you make on trades that you've held for less than a year are taxed like regular income. So it's a really good idea to just set aside about 25% of your profits for Uncle Sam so you don't get a nasty surprise later.
Okay, we've covered the nuts and bolts. We've talked about how to do it. But now we need to talk about the single most important rule of this whole strategy, the mindset that makes it all click.
This is it. This is the whole ball game. If the stock price drops after you buy it, you do nothing. You just wait. Why? Because you did your homework at the start, remember. You chose a quality company that you believe in for the long haul. This isn't a failed trade. It's just a little detour on the bus route. You trust the bus, you trust the driver, and you know the destination. So you just hold on and wait for the price to come back. You only lose money if you get scared and sell.
And that kind of brings us to the final question, doesn't it? This strategy really suggests that the biggest danger to your success isn't a bad market, it's your own impatience. By taking emotion out of it, picking great companies, and just having the patience to let the bus get to where it's going, you can build a really powerful and way less stressful path to generating income. Thanks for watching.